Now it's time to bring in our first guest, Greg McBride. He's the Senior Vice President and Chief Financial Analyst for Bankrate.com. He's appeared on hundreds of national cable and television networks, including NBC, CBS, CNBC, Fox Business. Greg, thanks so much for being here today.
Thanks for having me.
So we're talking about the Secure Act. Net, do you think the Secure Act was a positive thing? Do you think it's a negative thing? Give me your take on it.
Yeah, I think it's a positive because it does reflect the changing nature of retirement, and specifically longer lifespans and working later in life, even if that's on a part-time basis. A couple of provisions I think really speak to that, raising the age for required minimum distributions to age 72 and removing the age limit on contributing to a traditional IRA. Both of those, I think, reflect the new reality of retirement.
Sure. And I talk a lot about when you get to the age of RMDs, in an ideal world, you want to earn enough interest and dividends if you can to be able to take those RMDs from interest and dividends, at least in the early years, and not have to spend down principal. So by going out to age 72, it essentially gives people a little longer time to make that transition, correct?
Yeah, absolutely. It gives your money a little bit longer to compound. And it's also less time over which you're going to be drawing that out. And, for so many people that have a shortfall of retirement savings, that year and a half difference can really make a big difference.
Now, it's interesting because we're talking this week, and we just came off of a heck of a week in the stock market, a heck of a week with interest rates, the 10-year Treasury yield, the interest rate on the 10-year government bond, that is, actually got lower than it was during the peak of the financial crisis. So here we are during the financial crisis, this great flight to quality, if you will, because of people being concerned. And now there's even a bigger flight to quality. And the coronavirus really isn't anything compared to the financial crisis. So 45 seconds, so what do you make of what we're seeing right now with interest rates?
Well, markets hate uncertainty. And right now there's a ton of it because of the coronavirus. That's kind of newly charted territory. And so it's not surprising to see a stock market correction in the face of that. Also, interest rates coming way down. But keep in mind, in a global context, our interest rates still much higher than a lot of other developed markets.
Yeah, it always makes me, in fact, I want to ask you right after the break your thoughts about that as a fellow CFA. It seems weird to me that we can go ahead and buy Italy bonds and actually earn more interest than we can on, or earn less interest than we can on our own U.S. government bonds. So we'll talk about that coming up right after the break. You stay with us. We'll take a quick commercial break. We'll be right back with more words of wisdom from our new friend, Greg McBride. We'll be right back. Welcome back to the Income Generation, and let's welcome back also our new friend, Greg McBride, Senior Vice President and Chief Financial Analyst for Bankrate.com. Greg, thanks for sticking around.
My pleasure. Thanks.
So again, what do we make of this? When you go to a country whose debt is theoretically riskier than ours, and you could say Italy, Spain, you could almost fill in the bank with some European countries, but yet our bonds are still paying more interest than theirs. How do you make sense of that globally?
Well, a lot of this boils down to economic growth. Right now, the U.S. economy is growing at a much faster pace than most, if not all, other developed markets. And as a result, the interest rates in those economies are much lower. Their central banks may have negative benchmark interest rates. Ours, by comparison, much higher than that. And to your point, Greece, believe it or not, their 10-year government bond actually yields less than 1%. So below the top credit quality U.S., again, a reflection of the strong relative economic performance we've seen here in the U.S.
And it wasn't that long ago we were talking about whether Greece was even going to repay their debts at all, and yet their yield is lower than ours. It's amazing. So banks, today, if I want to go buy a 5-year CD or a 10-year CD, what's the best rate that you've seen through an FDIC-insured bank these days?
Yeah, right now on CDs, really of all maturities, there's not a big difference in yield. So you're not rewarded for going out, stretching out into longer maturities. Yields are in the low 2% neighborhood, 2.1, 2.2, maybe 2.4 if you stretch all the way out to 5 years. again, all you're really doing, I think, is locking yourself in at a rate that may not even keep pace with inflation. Right now, I think the real sweet spot, very short-term CDs or online savings accounts, having that liquidity so that you can, capitalize on opportunities as they present themselves, and you're not giving up much yield to have that flexibility.
But the only problem with the short term is a lot of people would say, and I'm one of those, that we have a new norm of permanent low interest rates, that if the economy's doing well and our rates are this low, imagine what happens in the next recession. We could even see negative short-term rates here in this country. So 30 seconds, how do we combat against that in the future if interest rates go even lower or are negative and this is the new norm?
Yeah, well, I agree. I think that, in a global context, we've got a lot of developed markets that have aging populations, slow economic growth, low interest rates, and even negative interest rates are going to be around for a while. I don't really like bonds for that reason, because if there's even a slight uptick in interest rates, you can take big losses. Dividend-paying stocks may be the way to generate income for a lot of retirees.
As long as the stock market holds, I guess we have to cross our fingers and toes and hope that we don't get a socialist in the White House. But assuming not, maybe it'll hold for a bit. Listen, Greg, thanks so much for being on the show. Really appreciate your time today.